Welcome to video 7 of part 2 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss S corporations. If you have not watched video 6 on C corps and you're not familiar with how C corps are taxed, you may want to go back and watch that video 6 before you watch this one. There are concepts introduced there that will be relevant here. Sometimes C corps elect S corp status, and that raises some tax issues. So if you don't understand how C corps are taxed, you'll be a little lost in places in this video. So with that said, let's begin our look at S corporations. This is what we will cover in this video. I'm not going to read all of it to you, but we will start with an overview of S corps and the Form 1120S. And then we are going to cover all of these different aspects of S corporations, all of which may be tested on the EA exam. Our free resources from irs.gov, we've only got two. They are both in bold. I definitely recommend both of them. That is Form 1120S and its instructions, along with Form 2553 and its instructions. As a recap and an overview of S corporations, they are often described as a corporation taxed like a partnership. That is because the profits and losses are generally not taxed at the corporate level. Rather, they flow through to the shareholders on Schedule K1, much like a partnership does. The shareholders pay tax on the earnings of the S corp even if no cash is distributed. But there are some differences between partnership and S corp tax, and we will discuss a few of those as we go through this video. Let's take a closer look at Form 1120S, which is the S corp tax form. We start at the top with the normal type of information. Then we have the income section that we have seen. Then we come down to deductions. You see the list there. And as with both the partnership and the C corp, if there are other deductions that are not listed here, you will attach a statement to list those out. Then we come down to the bottom, and you'll notice that it is possible to have a tax due and an overpayment or underpayment. And you might think that that's odd. Why would an S corp have tax due since they don't pay tax at the corporate level? Well, there are times that they can. If the S corp used to be a C corp, they convert to S corp status. There can be taxes that S corp sometimes owes. We will talk about those as we go through this video. The filing deadline for an S corporation is the 15th day of the third month following the end of the tax year. So that is March 15th for a calendar year. And of course, they can get an extension by filing this Form 7004. If they do owe any tax, of course, that extension does not extend the time to pay that tax. It is only an extension of time to file the return. The penalties for the S corp, like a partnership, as long as no tax is due, the penalty is $245 per month or part of a month per shareholder for up to 12 months. If there is tax due, the penalty is 5% of the unpaid tax for each month or part of a month, up to 25% of the unpaid tax. If it is more than 60 days late, like with the C corporation, the penalty is the smaller of the tax due, or $510, unless you can show good cause for why that return was not filed on time. And the penalty for late payment is 0.5% of the unpaid tax per month, up to that maximum of 25% of the unpaid tax. Also, like the partnership, there is a penalty for failure to furnish the information returns, the K1s and the K3s. It is $330 each, unless it is intentional, in which case it is $660 or 10% of the aggregate amount of items required to be reported on the K1 or the K3. So what are the requirements to qualify for S corp status? We've talked throughout part 2 about making an S corp election and if you qualify. So what does that mean? You will want to know these qualifications for the exam because it will definitely be tested. First of all, the corporation must be a domestic corporation. Secondly, there is a maximum of 100 shareholders. You will definitely want to know that number. 100 shareholders is the maximum. However, there is this exception. Family members and their estates are treated as just one shareholder, no matter how many of them there are. Family members for this purpose includes lineal descendants of a common ancestor and their spouses or former spouses up to 6 generations. So lineal descendants, we're talking about, for instance, grandparent, their child, the grandchild, the great grandchild, all the way up to 6 generations. All of them and their spouses, including former spouses, all count as just one taxpayer when you are adding up your 100 maximum. And then all shareholders must be individuals, estates, certain tax exempt organizations, and certain trusts. So we will look at a more specific list here in a little bit. Individual shareholders must be either citizens or residents of the United States. So, in other words, there can be no non-resident alien shareholders. All of the shareholders must consent to the S Corp election, and there can only be one class of stock, disregarding differences in voting rights. Generally, this means that all shares of stock confer identical rights to distribution and liquidation proceeds, which means there is no preferred stock. There are some types of corporations that cannot be an S corporation. First of all, a bank or thrift institution that uses the reserve method of accounting for bad debts, an insurance company, or a DISC, which is a domestic international sales corporation. So you'll just want to remember that list. The S Corp has to have or adopt one of the following tax years, a calendar year. So that is the general rule for S Corps, is they must have a calendar year. But as you will recall when we talked about tax years, there can be other tax years that are allowed or elections that can be made. You'll want to read through that list and be familiar with it. But the general rule, again, that you'll want to know is that they should have a calendar year. Here is that list of the specific types of shareholders that are and are not allowed for an S Corp. So those that are eligible are individuals, as long as they are U.S. citizens or resident aliens, estates of decedents, bankruptcy estates, 501c3 charitable organizations, grantor trusts and testamentary trusts, and then a couple of special kind of trusts that we will talk about a little bit more: the qualified subchapter S trust and the electing small business trust, and then ESOPs, employee stock ownership plans, and then qualified retirement plans can also be a shareholder in an S Corp. So who is not eligible? Of course, non-resident aliens, foreign trusts, charitable remainder trusts, not eligible, C corporations and S corporations. So any other type of corporation cannot be a shareholder in an S corporation. There is this one exception for a Qsub that we will talk about. And then partnerships cannot be a shareholder in an S corp. Similarly, a multi-member LLC cannot be a shareholder in an S corp. Of course, a multi-member LLC defaults to being taxed as a partnership, and then a limited liability partnership cannot be a shareholder. And then finally, an individual retirement account cannot be a shareholder in an S corp. A qualified retirement plan can, but an IRA cannot. The qualified subchapter S subsidiary. So if an S corporation owns 100% of another S corporation, that S corporation that it owns is called a Qsub, or a qualified subchapter S subsidiary. That Qsub is disregarded for federal income tax purposes and does not file a separate return. So since it's owned 100% by another S corporation, it's disregarded. It's like it doesn't even exist. And so they just file one tax return to report all of both companies' income and expenses. And there could be more than just two, but thinking of two just makes it easier to think about. And remember, other than this, other than a 100% interest, an S corporation cannot be a shareholder in another S corporation, and a C corporation cannot be a shareholder in an S corporation. Let's talk about those special kind of trusts that can be S Corp shareholders. You may get a question or so on the exam about these, so you just want to be generally familiar with them. First one is a qualified subchapter S trust, or QSST. The qualifications for that trust is that it can only have one income beneficiary. Any corpus can only be distributed to that beneficiary. The income interest must terminate at the earlier of the death of that beneficiary or the termination of the trust. Upon termination of the trust must distribute all of its assets to that beneficiary, and all income must be distributed to the beneficiary every year. So the key theme here is it is only one beneficiary for everything. So that is a qualified subchapter S trust. You'll just want to remember those qualifications. The main thing is it's one beneficiary. Next is an electing small business trust, or ESBT. The qualifications for this are the beneficiaries can only be individuals, estates, or certain charities. An interest in the trust cannot have been purchased. It must have been acquired by gift or inheritance. So this is a way to pass on S Corp stock through either a gift or inheritance. That is what it is designed for. And in order to qualify, the trustee must elect to be treated as an ESBT, and they make that election under Section 1361E3. And any potential current beneficiaries must be eligible S corporation shareholders, except they will allow a non-resident alien to be considered eligible for this purpose. So how do we go about actually electing S Corp status? First of all, S Corp status, as you'll recall, can be elected by qualifying corporations, limited liability companies, limited liability partnerships, and limited partnerships. In order to do so, they complete Form 2553, and it must be completed either no more than 2 months and 15 days after the beginning of the tax year that they want the election to take effect, or at any time during the tax year preceding the tax year they want it to take effect. And when you're counting your 2 months and 15 days, the 2-month period begins on the first day of the tax year and ends on the close of the day before the numerically corresponding day of the second calendar month following that month. Then add 15 days. So why do we go through all of this language in order to describe 2 months and 15 days? Well, if it's at the end of a calendar year and we just want to be effective for the next calendar year, then it's pretty easy. It's March 15th. You have to file the 2553 by March 15th. But what if the corporation came into existence on some other day during the year? Then we need to be able to figure out exactly what is 2 months and 15 days. So let's look at some examples. Example 1. Corporation D begins its first tax year on January 7th of 2024 and wishes to be taxed as an S corporation. They must file their S corp election by March 21st of 2024. So you start on January 7th, you go ahead 2 months, that's March 7th. Then you go back 1 day, that's March 6th. Then you add 15 days, that's how we get to March 21st. Example 2, this is the more straightforward example. Corporation E has been filing as a C Corp with a calendar year and now wants to make an S Corp election for 2024. They must make that election by March 15th of 2024. And then example 3, Corporation F begins operations on November 8th, 2024 and wishes to file as an S Corp. They must file their election by January 22nd, 2025. So again, you take November 8th, add 2 months, that's January 8th of 2025. Go back a day, that's January 7th. Add 15 days, you end up at January 22nd of 2025. In certain cases, the IRS will accept a late S Corp election. However, you must show reasonable cause for the late election and that the corporation acted diligently upon discovering the failure to file. So sometimes you might have a situation, for example, where the attorneys are helping to set everything up and they fill out the 2553, and the attorney thinks the client's going to file it, and the client thinks the attorney's going to file it, and so it doesn't get filed on time, or some situation like that. So if you have a situation where you really did mean to file it, you just, for whatever reason, didn't get it done, then there is actually a procedure to follow in order to request this late election. That is laid out in Revenue Procedure 2013-30 and in the instructions to the Form 2553. And as we'll see here in a minute, there's actually a place on the 2553 to address this issue. But the IRS is under no obligation to grant this relief or to allow the late filing. That said, if you legitimately did have a good reason that it wasn't filed, they generally will allow the late election. So let's look at that 2553. You're going to start at the top with your normal information, when you want this to be effective, what your tax year is going to be. You do have to name someone as a legal representative to talk to the IRS. And then you can see Section I here. This is all about why you did not file on time. So this is where you can give your reasoning for not filing on time and show that you did act diligently once you discovered that you had not filed. So as you can see, these late filings are so common that a good portion of page 1 of the 2553 is dedicated to explaining your reasons why you are filing late. Then we go to page 2, and you will see here, this is where all the shareholders have to sign. Remember, 100% of the shareholders must consent to the election, and they have to sign, and this is where they do so. Once it is filed, then the IRS should notify the corporation of their acceptance or non-acceptance within 60 days. If the corporation does not get that notice within 2 months, they should call the IRS to inquire. And when they send the election in, it should be sent certified mail, return receipt requested, or by a comparable method with a private delivery service such as UPS or FedEx. And you want to do that so that you can prove, if you have to, timely filing. Let's face it, the IRS is a large bureaucracy. Things can get lost. So you want to be able to prove that you did, in fact, file this on time. And by the way, this goes with anything you send to the IRS. If you are sending something through the mail to the IRS, then you should be sending it certified mail, return receipt requested. You want proof of mailing, and then when they get it, they'll sign that little green card and they'll send it back, and you keep that as proof that they actually did receive it. You can do that, or again, you can send it FedEx or UPS or whatever, but you want some proof that it actually was delivered, no matter what you are sending to the IRS. Revocation or termination of the S-Corp election and of S-Corp status. So an S-Corp will cease to be an S-Corp and revert to being taxed as a C corporation if any of the following occur. First of all, if the shareholders revoke the election in writing. Secondly, if the corporation no longer qualifies to be an S-Corp, so they no longer meet all of those qualifications that we talked about. Or if this is a former C corporation with accumulated earnings and profits, and that corporation violates the passive income restrictions, then that S Corp will cease to be an S Corp. We are going to talk about each of these things in turn. But once the S Corp status is terminated or revoked, the corporation must wait at least 5 years before again requesting to be an S Corp, although the IRS may allow exceptions at their discretion. But you will want to remember this 5 years. If your S Corp status terminates, whether you revoke it or it terminates for one of these other reasons, then you cannot request S Corp status again for 5 years. So now let's talk about revoking the S Corp election. Shareholders holding more than 50% of the company's stock can revoke the S Corp election. So remember, to make the election, you needed how much? 100% of the shareholders had to consent. To revoke it, you just need more than 50% of the stockholders. So it's not the number of shareholders necessarily, it's those that hold more than 50% of the company's stock. Those are the shareholders that need to agree in order to revoke the S Corp election. They revoke it by filing a statement requesting to revoke it, and the shareholders sign a consent statement in order to show that they have more than 50%. And that must be filed by the 15th day of the third month of the tax year to be effective as of the first day of that year. So for a calendar year corporation, that would be by March 15th. If it's filed after that date, then that revocation will be effective for the following tax year. So no longer qualifying. If the corporation no longer meets the qualifying conditions to be an S Corp, then its S Corp status terminates at that time. So for example, S Corporation G sells new shares of stock to new shareholders, bringing its total number of shareholders to 105. The corporation no longer qualifies to be an S Corp and will revert to being a C Corp. So since they went over that 100, the magic number, no longer qualifying, as soon as they do that, the S corporation status terminates. Inadvertent termination. So if an inadvertent S corp termination occurs and the company takes steps to correct the problem within a reasonable time, then the IRS may allow the company to maintain its S corp status. So for example, Joe, a shareholder in S Corporation H, sells his shares to Patrice, who, unbeknownst to the company, is a non resident alien. By law, this terminates the S Corp election. A few weeks later, the company discovers Patrice's non resident status and takes steps to buy her shares back. The company can request permission from the IRS to disregard the inadvertent termination. Again, the IRS doesn't have to grant it, but if you can show that it really was inadvertent and that you really did fix it as soon as you found out about it, then it is likely that the IRS will grant that relief. Passive income restrictions. When a C corporation converts to S corp status, it may have accumulated earnings and profits which were never distributed to the shareholders. Remember, we talked about E&P in the previous video. Since that E&P was never distributed, it was never subject to double taxation. Well, once it becomes an S corporation, if passive income, so interest, dividends, capital gains, sales of passive activities, royalties, passive rents, if that type of income exceeds 25% of the total gross receipts of the corporation for 3 consecutive years, then the S Corp election terminates on the first day of the 4th year. So what's going on here? The IRS does not want a C Corp that has accumulated a bunch of earnings converting to S Corp in order to avoid double taxation on those earnings. So what they're saying is if you convert to S Corp status and a substantial portion of your gross receipts is simply from investing all of the earnings that you have built up, so you're getting interest, dividends, capital gains, etc., that's more than 25% of your income for 3 consecutive years, then they're going to say, hey, all you're doing is sitting on those accumulated earnings and profits in order to avoid paying the double tax. We're not going to let you do that. We're going to force you to convert back into a C corporation. So that is the purpose of this passive income restrictions. So if you do that for those 3 years, on the 4th year, you will once again be a C corporation. And remember, once you go back to being a C corporation, you have to wait at least 5 years before you can elect S corporation status again. Pass-through items. So, much like a partnership, each shareholder shares in the profits or losses of the corporation in proportion to their percentage of ownership. Unlike a partnership, the profit sharing percentage cannot be different than the ownership percentage. So remember, when we talked about partnerships, we had that example where the partners, one of them was a 1% capital percentage partner, the other was a 99%. But for profit sharing purposes, they were 25% and 75% because with a partnership, you can do that. You can have different percentages. With an S Corp, you cannot do that. If someone has a 1% capital interest, in other words, they own 1% of the stock of the corporation, then they get 1% of the profits or losses. You cannot make it a different percentage. Whatever those percentages are, though, the profits and losses flow through to the shareholders on a separate K1, and then the shareholders report those profits on their own tax return. And like a partnership, those profits are taxable even if little or no cash was distributed out to the shareholders. Separately stated items. As with the partnership, certain items are not taken into account in computing the corporation's net income. Remember on page 1 where you show the income and expenses, there are certain items that are not included there and instead are separately stated on K1s to the shareholders. Examples of separately stated items: portfolio income, interest, dividends, etc., Section 179 deductions, Section 1231 gains and losses, charitable contributions, rental income or loss, and AMT tax preference items. Basis, so as with other assets, when a shareholder owns S corporation stock, they have a basis in that S corporation. For an S Corp, basis determines all of the following. First of all, the amount of distributions that the shareholder can take tax-free. Secondly, the amount of flow-through losses and deductions that the shareholder can take. And then finally, the shareholder's gain or loss on their disposition of that stock. With an S Corp, there are actually two types of basis. There is stock basis and there is debt basis. They are computed separately, and neither of them can ever go below zero. So when we talked about a partnership, there's just one type of basis, your basis in that partnership. When we talked about a C Corp, there's only one type of basis, your basis in the stock of that C Corp. With an S Corp, you have both stock basis and debt basis. Stock basis can be used to take tax-free distributions as well as to deduct flow-through losses and deductions. Debt basis, on the other hand, cannot be used to take tax-free distributions, but it can be used to deduct flow-through losses and deductions. Distributions are applied first, and any distributions in excess of stock basis are capital gains, no matter how much debt basis there may be. In other words, if during the year you have both distributions and losses, the distributions are going to be applied first before you apply the losses. So you're going to apply the distributions. Those are only applied against stock basis, and any distributions in excess of the stock basis are capital gains. So remember, the stock basis is you're basically giving the shareholder their money back for what they've invested, so that's not taxable. But any amounts in excess of that basis are capital gains. And it doesn't matter how much debt basis the shareholder may have, they can't use that to offset distributions. We are going to talk more about this. So if you don't quite get it yet, that's okay. Bear with me. We're going to get more into the details of this. And then also don't forget, there are still at-risk limits and passive activity loss limits. So you've got all three. If you have especially losses from the company, that's when you're really going to be concerned with this. You're going to want to know, first of all, does the shareholder have amounts at risk? Secondly, do the passive activity loss rules apply? Do we have to worry about those? And then thirdly, do they have basis? So you have to consider all three of those things. So let's talk about stock basis first. Stock basis is increased by the following: stock purchases and additional paid-in capital. That makes sense. Ordinary income that flows through from the S corporation, that increases basis. Separately stated income that flows through increases basis. Tax exempt income, obviously it's not showing up as flow through income per se, but it is still income. It will still be reported on the K1, and it does increase basis. And then excess depletion increases basis. Of course, there are more particulars about that, But for the exam, just remember that excess depletion increases stock basis. Stock basis is decreased by distributions to the shareholder. So contributions increase basis, distributions decrease basis. Ordinary losses that pass through to the shareholder decrease basis. So remember, income that passes through increases basis, losses decrease basis. Then separately stated loss and expense items decrease basis. Again, separately stated income increases basis, separately stated losses and deductions decrease basis, and then non-deductible expenses. So just like tax-free income increases basis, non-deductible expenses decrease basis. Then we have debt basis. So debt basis is created or increased by the shareholder making a bona fide direct loan to the corporation. So there is no basis for the debts of the S corporation itself. Remember, with a partnership, for qualifying debts, the partners actually get basis in the partnership for their share of the partnership's debts. You do not have that with an S corporation. The shareholders do not get basis for the debts of the S corporation itself. They only get debt basis for amounts of money that they have actually loaned directly to the S corporation. Also, a shareholder's loan guarantee of corporate debt does not increase debt basis. Again, that's different than with a partnership. But the loan guarantee in an S corp does give them at-risk basis. So when you're looking at those things, do we have at-risk basis? If the shareholder is guaranteed a loan of the S corporation, then they do get at-risk basis, but they do not get any type of stock basis or debt basis for that guarantee of the S corp's loan. Debt basis is reduced by loan repayments to the shareholder and by losses taken against the debt basis. So obviously, if you're loaning money to the corporation, that gives you debt basis. If they pay that money back, that decreases your debt basis. And then if you take any losses against the debt basis, that also decreases that basis. So let's look at an example to try to understand this a little bit better. Paul is the sole shareholder of Paul's Pretzels, Inc., which is an S Corp. His stock basis is $10,000 and his debt basis is $15,000 from a direct loan to the company. During 2024, Paul takes a $12,000 distribution and the S Corp has a loss of $8,000. So Paul has a capital gain of $2,000 because remember, distributions are applied first. So he's got $10,000 of stock basis. He takes a $12,000 distribution. So the first $10,000 of that distribution is a return of capital. It is not taxable. However, the extra $2,000 is a taxable capital gain. He then can recognize that $8,000 loss. How can he recognize the loss if he doesn't have any stock basis? Well, because he has this $15,000 of debt basis. So assuming no other items that affect basis, at the end of 2024, Paul's stock basis is zero and his debt basis is $7,000. So it was the $15,000 he started with minus the $8,000 of losses he took on his tax return, leaves him with that $7,000. Note here that Paul may have been able to designate that $12,000 payment as a loan repayment rather than as a dividend, thereby avoiding the $2,000 capital gain. So he distributed $12,000 here, and he called that a distribution against the stock, which resulted in him having that $2,000 capital gain. What he could have done instead, potentially, was say, no, I'm just paying back this $15,000 or $12,000 of the $15,000. That would have avoided this $2,000 capital gain. However, for purposes of our example, so that we could see how all of this works, that is not what Paul did, and so he does have to pay the $2,000 capital gain. Sorry, Paul. Restoring basis. When stock and debt basis have both been reduced, any basis increase from subsequent income items is applied first to debt basis and then to stock basis. So, for example, with Paul's Pretzels, remember at the end of 2024, he had no stock basis and his debt basis was $7,000. Let's say in 2025, the company has a profit of $15,000. $8,000 of that profit is used to first restore the debt basis back to $15,000. And so now the stock basis is $7,000. So what you will want to remember is that when you are restoring basis from income, it is applied first to debt basis and then to stock basis. Debt discharge income. Remember, we said that non-taxable income generally increases basis. However, there is an exception for discharge of indebtedness income or debt cancellation income. That debt discharge income may be tax-free, but even if it is, it does not increase shareholder basis. So that is an exception. You will want to remember that for the exam. Debt cancellation income, if it's tax-free, does not increase shareholder basis. If it is taxable, it does increase shareholder basis. If it is tax-free, it does not. Our next topic is distributions or dividends from the corporation to the shareholders. Distributions up to the amount of stock basis are generally tax-free. Distributions in excess of stock basis result in a capital gain to the shareholder. So remember, the S Corp shareholders pay tax on the income of the S Corporation regardless of whether or not there are any distributions that are made. Therefore, when the distributions are made, there's no tax. That money has already been taxed. So therefore, no tax on the distributions, as long as you are not making distributions in excess of the shareholders' basis. So distributions up to the amount of the shareholders' basis, not taxable. Amounts in excess of the shareholders' basis are taxable. There is an exception to this tax-free treatment of distributions for former C Corps that have earnings and profits. Their distributions may be fully or partially taxable depending on the balance in something called the Accumulated Adjustments Account, or AAA. So let's look at AAA. The Accumulated Adjustments Account keeps track of the undistributed taxable S Corporation earnings. It is required to be kept. You have to keep track of AAA for any corporation that has earnings and profits. In other words, you used to be a C corporation, you had earnings and profits, you converted to being an S corporation, then you must keep track of your AAA. It is optional for everybody else. So if you have an S corporation, it's always been an S corporation, you do not have to keep track of AAA, although you are allowed to, and the IRS actually recommends that you do so, but it is optional. You do not have to. But if you used to be a C corporation, you have earnings and profits, you convert to an S corp, you have to track AAA. Distributions to shareholders are not taxable to the extent there is a balance in the accumulated adjustments account. Distributions in excess of the amounts in AAA are taxable if the corporation has earnings and profits from when they were a C corporation. If they have taxable distributions, they do not reduce stock basis, while non-taxable distributions do. So remember, let's forget about AAA for a minute. If you've just got an S Corp shareholder, distributions up to the amount of their basis are not taxable to them, but they do reduce that shareholder's basis in their stock. So distributions that are not taxable reduce your basis, but any taxable distributions that you may get from earnings and profits do not reduce your basis. AAA is kept at the corporate level, not for each shareholder. So when we talk about stock basis and debt basis, that is a shareholder by shareholder calculation. Each shareholder is going to have their own particular stock basis and their own particular debt basis. AAA is not kept that way. It's at the corporate level. because what we are trying to track is the amount of undistributed S corporation earnings. So that is done at the corporate level. And AAA is increased the same way stock basis is, except that stock purchases and additional paid-in capital do not affect AAA. AAA is tracking the earnings of the S corporation. So contributions of capital are not earnings, so they do not affect AAA. Also, tax-exempt income and expenses do not affect AAA. So remember, tax-exempt income, non-deductible expenses, those increase or decrease basis. They do not affect AAA. We'll talk about what we do with those here on the next slide. And unlike stock basis, AAA can have a negative balance due to losses, but not due to distributions. So now let's talk about what we do with those non-taxable amounts and those non-deductible expenses. This is the other adjustments account. So OAA is used to keep track of the tax-exempt and non-deductible items that are excluded from AAA. Why do we keep track of those? Because remember, even though they don't affect AAA, they do affect basis. So we want to track them. OAA is increased by tax-exempt income and reduced by tax-exempt expenses. So we're only going to show in OAA tax-exempt items, both income and expenses. OAA is also reduced by any federal income tax that is paid by the S corporation for items related to when they had been a C corporation, which we're going to be talking about those later in this video. But remember, federal income tax, not a deductible expense, so it is consistent that it would be applied to the other adjustments account. So why are we going through all of this? You may be a little lost right now trying to figure out, what are we doing here? We've got taxable S corp items in a AAA account. We've got non-taxable S corp items in OAA account. We're talking about earnings and profits. What's going on? So let's explain exactly what is happening. The reason we are tracking all of this is to figure out when the corporation makes distributions, are those distributions taxable to the shareholders? That's what we need to know. And when we have a former C corporation with earnings and profits that converts to an S corporation, it complicates the situation, because the law will not allow you to avoid double taxation on C corp profits by converting to an S corporation. So if you have accumulated earnings and profits from when you were a C corp, those are supposed to be taxed twice, once at the corporate level and then second time when they are distributed out to the shareholders. Well, in this case, you converted to S corp status before you distributed out those C corp earnings. So if you then distribute out those C corp earnings after you make your S corp election, the shareholders still have to pay tax on those earnings, just as if they were still a C corporation. So we are going through all of these calculations in order to figure out, when the corporation distributes out earnings, when are they distributing out S corporation earnings that are not taxable, and when are they distributing out C corporation earnings that are taxable? That's what we're doing here. So when the corporation makes a distribution to the shareholders, the first distributions that they make will be assumed to come from S corporation earnings, and therefore they will not be taxable to the shareholders. So that's what AAA is. AAA is keeping track of taxable S corporation earnings. The shareholders pay tax on those earnings when the amounts flow through on the K1 to their personal tax returns. So those amounts, the S corp earnings, have already been taxed. They're paying tax on it through the K1. So when there is a distribution of those earnings, they don't have to pay tax on them. So distributions from S corporation earnings, which is tracked in AAA, are not taxable to the shareholder. And the first distributions that the corporation made will be assumed to come from AAA, not taxable. If the corporation then keeps making more distributions, so they distributed out all of the taxable S Corp earnings, they're still making more distributions. The next distributions will be assumed to come from C corporation earnings and profits, and those are taxable. Then, if they're still making more distributions, so they've distributed out all of the S Corp earnings from AAA, they've distributed out all of the accumulated C Corp earnings from E&P, now those distributions will be assumed to come from the non-taxable income of the S corporation, which is the OAA account, and those distributions are not taxable. Again, they're coming from the S corp. Distributions of S corp earnings are not taxable. So those distributions from OAA not taxable. If they then are still making more distributions, that will be considered a return of their stock basis, a return of capital. So those distributions are not taxable. If they then distribute even more, that is a capital gain. So they distributed out all of the earnings, all the S Corp earnings, all the C Corp earnings. They've returned stock basis, still making distributions. That then is a capital gain. Note, if it were not for them having been a C corporation, these first three things would not be an issue. If they had never been a C corporation, we would not worry about what's in AAA. There would be no E&P. We would not worry about what's in OAA. We would simply say, does the shareholder have stock basis? So if they're making distributions up to the amount of stock basis, not taxable. In excess of the stock basis, it is a capital gain. But because they did used to be a C corporation here, we do have to determine all of these things. So if you need to, rewind this video a few minutes to where we started talking about all of this and come back and watch it again so you can understand what we are doing with these various accounts. For the EA exam, you will want to remember this. You want to remember this order. The distributions come first from AAA, not taxable. You want to know that. Then they come from earnings and profits, taxable. Then from OAA, not taxable. Then stock basis, not taxable. And then in excess of stock basis, capital gain. There is one election that the corporation can make, and that is to consider the first distributions made to come from earnings and profits rather than from AAA. So they can elect to reverse the order of these first two things and to say, no, we want the distributions to come from earnings and profits first. So those distributions, of course, would still be taxable. So you might say, why would they do that? They could take the distributions and have them not be taxable. Why would they want to pay tax? So we will talk about that here in a minute. But if they make this election, they usually do it with something called a deemed dividend. With a deemed dividend, you're playing make-believe. No cash is actually distributed, but you treat it as if it were distributed, and then the money was immediately reinvested back into the corporation. So the shareholder does have a dividend in this case, even though they didn't actually receive anything. It is a deemed dividend. So they have to pay tax on that dividend. However, we are then assuming that they reinvested that money back into the S corporation. When you make an investment into an S corporation, what happens to your stock basis? It increases. So you took a dividend, you have to pay tax on the dividend. However, you now get to increase the basis of your stock for the amount of that dividend. So maybe you're starting to see why you might want to do this. Let's say you've got just one shareholder to make it easy, in that they have no basis. They have no stock basis. They have no debt basis. And the S Corp has a $30,000 loss for the year. Well, if they don't have any basis, they cannot take that $30,000 loss. It is suspended until some future time when they have basis and they can take it. So if the corporation has accumulated earnings and profits, let's say they've got E&P from when they were a C corporation of $20,000. What they can do is say, let's do this election and let's make the first distributions E&P. So they can take a $20,000 distribution from the corporation. Again, no cash is actually changing hands, but it will be a deemed distribution of $20,000. They have to report that on their tax return, but they now get basis for that $20,000. So now you've got that $30,000 loss that they had from the year. They can now use $20,000 of that $30,000 loss. So they will have a taxable dividend of $20,000, and they will have a tax loss flowing through from the S Corp of $20,000. So those two amounts will net out. So in effect, they will pay zero tax on their accumulated E&P. And now their accumulated E&P is gone. They don't have to worry about it ever again. And they didn't have to pay any tax on those amounts now. So that is why you might want to make this election to do a deemed dividend. Post-termination transition period. When an S Corp election terminates, the rules for distributions normally revert to the C Corp rules. So you were an S Corp, you either now revoked it or it terminated for one of those other reasons that we talked about. So you're no longer an S Corp. So now if you make distributions, technically you are a C corporation. So any distributions would be treated normally as a C Corp distribution, which of course means they would be taxable. However, you get this kind of grace period called the post-termination transition period, when even though you are technically a C corporation, you can treat the distributions as if you were an S corporation, and therefore they will be tax exempt up to the stock basis, following all of those rules that we just talked about. This transition period begins the day of the S Corp termination and ends on the later of 1 year after the S Corporation termination date, or the due date, including extensions, of the final S Corp tax return. So you get to treat any distributions made to the later of those two dates as if they were S Corporation distributions, even though technically you are a C Corporation. Liquidating distributions. When an S Corp liquidates, the same rules generally apply for liquidating distribution as for all other S Corp distributions. Any distributions from a complete liquidation is treated as full payment for the shareholder's stock. The shareholder will have a gain or loss on disposition of the stock. So that makes sense. The corporation is liquidating, they are going out of business. So the shareholder is deemed to have sold their stock back to the corporation for the amount of whatever distribution they get from the liquidation. So they have a gain or loss. Any previous losses which were suspended due to basis limitations are permanently lost. So if they had losses from the S Corp, they had no basis, couldn't take those are going to be permanently lost when the S Corp liquidates. If they had previous losses that were suspended due to passive activity limitations, those losses can be used to offset the gain from the disposition of the stock. So you'll want to remember that. Passive activity losses that were suspended can be used to offset the gain from the disposition of the stock, but suspended losses from the S corporation itself cannot be used to offset the gain from the liquidation. S corporation taxes. So as we said, The general rule is that an S corporation does not pay federal income tax at the corporate level. However, if the company was previously a C corporation, there can be instances when the S corporation does pay income tax. And these are those instances. We are going to talk about each of these. So there's something called the built-in gains tax, then the LIFO recapture tax, the excess net passive income tax, and the investment credit recapture tax. So first, the built-in gains tax, or the big tax. When a C Corp elects S Corp status, the S Corp itself could potentially pay taxes on any built-in gains. The built-in gains tax applies if, at the time of the S Corp election, the combined total fair market value of the corporation's assets exceeds their basis in those assets, and any of the property is sold within 5 years of the S Corp election. So what we are talking about here is appreciated assets. What the IRS does not want taxpayers doing is having a bunch of appreciated assets in their corporation when it's a C Corp and then converting to S corporation status in order to avoid paying the double tax on that appreciation. So if the C Corp stayed a C Corp and they had these appreciated assets and they sold these appreciated assets, of course, the C corporation would then have a gain on the sale of those assets and would pay tax at the C corp level. And then when those gains are distributed out to the shareholder would also pay tax. So you would have a double tax on that gain. That's the way C corporations work. So what you could have some owners do is say, hey, we don't want to pay double tax on this appreciation of assets. So let's elect S Corp status. Then we'll sell those assets. We won't have to pay a double tax, and we will avoid the extra 21% tax on the appreciation of those assets. The IRS is saying, no, 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 you can't do that. If you sell any of those assets within 5 years of electing S Corp status, then you are going to have to go ahead and pay that 21% tax, just as if you were still a C corporation. Now you might say, well, what if you just plan ahead, make the S Corp election, and then wait 5 years or more to sell those assets? Well, if you do that, then good for you. You are in the clear. You will be able to avoid the double tax in that instance. I think the IRS knows that most of the people, if they're doing this, they haven't thought that much far ahead, and they just want to go ahead and sell those assets pretty soon and get the proceeds from that and avoid the double tax. But if you can wait the 5 years, then you're good to go and you do not have to worry about this. Now, this big tax also applies to accounts receivable for cash basis taxpayers. So, of course, if you are a cash basis taxpayer and you're a C Corp in this instance, then you did not recognize the income when it was earned. So maybe you billed the client hasn't paid yet, so you have this account receivable. You have not yet recognized that income. Well, again, you cannot now convert to an S corporation, then collect those receivables and avoid paying double tax on those receivables. So when you convert from C Corp to S Corp, if you were on the cash basis, any accounts receivable that you collect, the S Corp will then have to pay a 21% tax on those collections. Now, what they do let you do, however, is offset that with any accounts payable that you paid. Because, of course, you are on the cash basis, you don't get to take the deduction until you actually pay the expense. So, if you paid any of those accounts payable after the S Corp election, then you can deduct that amount from the amount of receivables that you collected, and you pay the 21% tax on the difference. The LIFO recapture tax. If a C Corp uses LIFO in its final year before electing S Corp status, then the LIFO recapture tax is due. So this is similar to the built-in gains tax because it taxes built-in gains in inventory. It is computed by subtracting the LIFO inventory value from what it would have been under either FIFO or lower of cost or market. So remember, with LIFO, it leads to higher cost of goods sold and lower ending inventory values. So in times of inflation, your inventory value under LIFO is going to be lower than the fair market value of that inventory. So just like with the other assets that we talked about with the big tax, you're going to have to pay a tax on the gain. But in this case, the gain is not the difference between the fair market value of those inventory items and your LIFO inventory. It is the difference between what that ending inventory value would have been under FIFO, or the average cost method, compared to what it is under LIFO. So you subtract the ending inventory as it stands with LIFO from what it would have been under FIFO, or average cost, and you pay the 21% tax on that difference. In this case, though, you do not have to pay it all in the first year. You can pay it in 4 annual installments. The first installment on the C Corp's final return, and then the other 3 installments are on the S Corp returns. With the big tax, you pay the tax in whatever year the asset was sold, or for accounts receivable, in the year that those receivables were collected. But with the LIFO recapture tax, you can spread it out over those 4 years. Next is the excess net passive income tax. So this is similar to and related to what we discussed before with the S Corp losing its S Corp election due to passive income. So an S Corp that used to be a C Corp must pay the excess net passive income tax if the corporation has accumulated E&P, passive investment income exceeds 25% of gross receipts, and the corporation has excess net passive income. How do you know if you have excess net passive income? Well, there is a formula that the IRS gives you that you do not need to know for the EA exam. So all you need to know for the EA exam is if you do have excess net passive income and you meet this other criteria, then you have to pay this excess net passive income tax. So again, what they're saying here is if when you were a C Corp, you accumulated a bunch of earnings, now you have converted to S Corp, and more than 25% of your gross receipts as an S Corp come from this investment type of income, interest, capital gains, etc., then first of all, if that happens for 3 consecutive years, you are going to cease to be an S Corp. You are going to revert back to being a C Corp. And secondly, in the meantime, while you are an S Corp, if you have excess net passive income as determined by this formula, then you're going to have to pay 21% tax on that excess. So you're going to have to pay tax as if you were still a C corporation on the amount of that excess net passive income. The investment credit recapture tax. An S Corp can be liable for the investment credit recapture tax if, when it was a C Corp, the company took an investment credit on an acquired asset and the S Corp sells or otherwise disposes of that asset prematurely. So there are certain credits a corporation can get that fall into this category of investment credits. They are reported on this Form 3468. So if you look up Form 3468 and its instructions, you can see which credits are the investment credit. If you're interested, you don't need to know that for the EA exam. What you do need to know, though, is if while they were a C Corp, they took this credit for one of those assets and then they dispose of that asset prematurely, so before its normal recovery period for the credit, then they have to pay 21% tax on the amount of that original credit that they ended up not in effect actually earning by holding the asset for the entire time that they should have held it. So you can see the common theme for when an S corporation has to pay taxes is when they had some sort of gain that they actually earned while they were a C corporation. Now they have converted to an S corporation, and the IRS is not going to let them then avoid double taxation by recognizing that gain when they are an S corporation instead of a C corporation. They are simply trying to prevent corporations from converting to S corporation status and avoiding double taxation in the process. That's what all of these taxes are doing in one form or another. Now we will switch gears and talk about shareholder pay and fringe benefits. Shareholders who work in the business are employees and are included on payroll with all the other employees. So this is just like a C corporation. So they are not self-employed like partners in a partnership, and they are subject to all of the normal withholding and payroll taxes. Shareholder pay must be reasonable. So we saw this with C Corps as well, and there is a similar concept with S corporations, though it's kind of in reverse. So let's talk about this. So first of all, what does reasonable pay mean? Well, it must be comparable to what an employee with similar experience, skills, and responsibilities would make at an unrelated employer in the same geographic area. So this is a common area of dispute between the IRS and S Corp shareholders. The shareholders with an S Corp want a low salary so that they can designate more distributions as dividends because distributions are not subject to Social Security and Medicare tax, but salary is. So if you have a large salary, you are going to be paying Social Security and Medicare tax on that salary. Whereas if you have a low salary, and you take the rest of your money as a dividend, as an S Corp shareholder, those dividends are not taxable income to you, and you don't have to pay any Social Security or self-employment tax on those dividends. So especially like a single member LLC, they may want to make an S Corp election, pay themselves a small salary, pay themselves a large dividend amount, and avoid that 15.3% self-employment tax that they would pay as a sole proprietor on the amount of those dividends that were paid. So the IRS says you must pay yourself a reasonable salary. If a reasonable salary for what you do is $75,000 and you're trying to pay yourself a salary of $20,000, the IRS is going to say, no, no, no. That extra $55,000 of dividends that you took, that really should have been salary, and you have to pay Social Security and Medicare tax on that difference. So that's what we're looking at with an S corporation. Remember, with a C corporation, the argument was kind of the opposite. With a C corporation, the shareholder wants to take a large salary because even though they have to pay Social Security and Medicare tax on it, if they were to take a dividend instead of salary, that dividend is taxable income to the shareholder and it is not deductible by the corporation. If the C corporation shareholder takes a large salary, yes, it is still taxable to them. Yes, they do have to pay Social Security and Medicare tax. However, the salary is deductible by the corporation, so they avoid that double tax by taking a large salary. So with a C Corp, the taxpayer is arguing that their salary should be high and their dividend should be low. And the IRS is arguing, no, your salary should be lower and your dividend should be higher. With an S corporation, it's the opposite. The taxpayer is arguing that their salary should be low and their dividend should be high. And the IRS is arguing, no, your salary should be higher and your dividends should be lower. Another argument that the IRS will often make is that if most of the income that is derived by the S corporation is from the shareholder's personal services, then most of the distributions should be in the form of salary rather than dividends. So let's say you are, for example, a tax preparer, and the income that you're getting through your S corporation is primarily from fees for filing tax returns. The IRS would argue that most of that income then should be in the form of salary, because if you are working for someone else preparing tax returns, then you would be getting a salary. It should be no different just because you happen to have an S corporation. Now, this can be argued. There's arguments on both sides of this. I'm just giving you a likely argument that the IRS will make, because they will try to make this argument. You can argue the other side, and you can go all the way to court if you want and let a judge decide. But these are the type of issues you have to work through as an S corporation shareholder and owner. If you want more information about this, I did make a separate video. It is on the EA Tax Training YouTube channel. It's not part of the course because it's not really relevant. It's outside of what's going to be tested on the EA exam, but it is called Should Your LLC Be Taxed as an S Corporation? It walks through all of these issues, gives you hints and advice on when you might want to consider being an S Corp and when you might not, etc., and so forth. So if you're interested, you can check out that video. But for the EA exam, you just really need to know that the S Corp salary has to be reasonable. It cannot be unreasonably low in order to allow the shareholder to avoid paying Social Security and Medicare tax on a large part of their compensation. Fringe benefits. So for purposes of most fringe benefits, a greater than 2% shareholder is going to be treated like a partner in a partnership, meaning the benefits are taxable. And you will want to know that greater than 2% shareholder rule. So if you are a greater than 2% shareholder, you are treated as a partner in a partnership for fringe benefit purposes and for some other purposes in the tax law. And so those fringe benefits will generally be taxable to you. There are some exceptions to that. So, for example, contributions to a qualified retirement plan do not count as taxable fringe benefits. There are a few others, but in general, they will be taxable. If the corporation pays the shareholders health insurance, that is taxable to the shareholder. However, they can take the self-employed health insurance deduction on their 1040 to offset that as long as they qualify. When they take that deduction, of course, one of the qualifications is the deduction cannot be greater than the net profit from the business. That's the same with an S Corp. But when you are looking at the profit from the S Corp, you can also include the wages that the shareholder received from the S Corp as part of the profits. Schedules K, K1, K2, and K3. If you are with us for the partnership video, this is going to be very similar. Schedule K is a summary schedule of all of the shareholders' shares of the corporation's income, credits, deductions, etc. So remember, just like with a partnership, Schedule K, you've got page 1, the normal operating income. That goes on Schedule K. That's the first line on the Schedule K. Then you're going to have rental income that is separately stated on the Schedule K. And then you've got all of the other separately stated items that are also shown on the Schedule K. And then those will be distributed out to the shareholders through their K1s. And this is what the Schedule K looks like. So you can see their ordinary business income, again, is line 1. So that comes from page 1. That's your ordinary income minus your ordinary expenses. Then your rental real estate is shown on line 2. Then you're going to have all of your other income and expense items that may be separately stated. Then this is the last part of Schedule K. Again, it is on top of Schedule L, and it is going to end with this line 18, which is the income or loss reconciliation. Again, this puts all of the S Corp's earnings, whether it is normal operations earnings from page 1 or whether it is separately stated items of income and expense, it all gets netted here on line 18. And when we do our reconciliation later on Schedule M1, this is the number that you will be reconciling book income to. Schedule K1 shows each shareholder's separate share of the income and expense items from the Schedule K. So the line item totals from all of the K1s will add up to the amounts on Schedule K. And of course, a copy of the K1 is going to be sent to each respective shareholder. And you should also send them their instructions for the K1. And the K1s are all attached to the Form 1120S that is sent to the IRS. So the IRS knows what to look for on the individual shareholders' income tax returns. And let us look at what the K1 looks like, much like the partnership one. So it starts with the information of the corporation. Then it is going to give shareholder specific information. It's going to have their current year allocation percentage, the number of shares that they own, loans from the shareholders. So again, this is to help them to establish their debt basis. Then you will see the various amounts. Again, line 1 is ordinary income, line 2, net rental income, etc. One difference with a S Corp K1 is that with an S Corp, you can have just one shareholder. So it could be that all of the amounts from Schedule K are going to be all on one shareholder's K1. With a partnership, of course, you're going to have at least two partners, so you have to have at least two Schedule K1s. Then schedules K2 and K3, they are used to report foreign source income and expenses. So Schedule K2 is an extension of Schedule K, meaning it consolidates all of the amounts for the corporation on one form. So remember, Schedule K already includes all of the foreign income and expense amounts in it. They're just buried in the amounts on Schedule K. What Schedule K2 does is it breaks out those foreign income and expense amounts onto a separate schedule so the IRS can see those amounts. And then what Schedule K3 does is it is an extension of K1, so it shows each shareholder's individual share of the foreign income and expense amounts that are shown on the Schedule K2. And like the Schedule K1, Schedule K3 is sent to each of the respective shareholders. Similar to with a partnership, not all S corporations need to file Schedules K2 and K3. They do not need to be filed if all of the following criteria are met. First of all, if there is no foreign activity or the foreign activity is limited to passive income with no more than $300 of foreign taxes paid or accrued, the passive foreign income must be reported to the corporation on a Form 1099 divs. Then all shareholders need to be notified when they receive their K1 that no K3 is being furnished, and then none of those shareholders request a K3 within 1 month from when they have filed the 1120S. So again, if you send them the K1, you notify them, hey, you're not getting a K3, and they come back within 1 month and say, no, I do need a K3, then you have to go back, issue the K2 and the K3s. And if they request it 1 year, you have to assume that they also need it the following year as well. Notice that there is no requirement listed here saying it needs to be a domestic corporation. Remember, the first requirement for partnerships was that it needs to be a domestic partnership in order to qualify to not have to file a K2 and K3. We don't have that requirement for an S corporation. Why would that be? Well, if you think about it, the very first requirement of being an S corporation is you have to be a domestic corporation. So every S corporation is, by definition, a domestic U.S. corporation. Therefore, it is not a separate requirement listed here. Now we will talk about Schedules L, M1, M2, and M3. If you were with us for our partnership and our C corporation videos, then this will look familiar, though there are some differences here with an S corporation. On the Form 1120S, the last 2 pages contain Schedules L, M1, and M2. Schedule L, of course, is the balance sheet per books. Schedule M1 is a reconciliation of book and tax income for corporations with less than $10 million in assets, so we will talk about that. Schedule M2 is different on the S Corp return. It is an analysis of AAA, undistributed income previously taxed, accumulated earnings and profits, and OAA. And then Schedule M3, as we've seen before, is a separate form, and it is a reconciliation of book and tax income for corporations with $10 million or more in assets. So let's look first at Schedule L. Looks a lot like the C corporation balance sheet. When we get down to the capital section, it is a little different here. On the C corp return, when we saw capital stock, it showed both common and preferred. With an S corp, you can't have preferred stock. You can only have one class of stock. So all of the par value will go on the capital stock line. Then you have additional paid in capital, then retained earnings, and it is not broken out between appropriated and unappropriated retained earnings. First of all, these are usually smaller corporations. And secondly, you don't have to worry about the dividends being taxable. So you don't need to worry as much about having appropriated retained earnings that are not available for dividends versus unappropriated that are available for dividends. Then you have your adjustments to shareholders' equity and your treasury stock, which will then bring you down to the total of the liabilities and shareholders' equity. Then we have Schedules M1 and M2. Schedule M1 is familiar. This is the reconciliation of book and tax income. So you start with your book income, you have your additions and subtractions for your book to tax differences, and then you will end with that amount from line 18 of Schedule K that we looked at. So that is the reconciliation. Then we have Schedule M2. So M2, you can see, looks different than on the other form. So this is when you have your accounts. You've got AAA, you've got your OAA, then you have the shareholders' undistributed taxable income previously taxed, and your accumulated earnings and profits. So remember, we're going to keep track of all that so we can determine the taxability of the distributions. As with the other returns, Schedules L and M1 are not required for certain corporations. If the corporation has less than $250,000 of gross receipts and less than $250,000 of assets, just like with the C Corp, then these schedules are not required. However, remember, Schedule M2 may still be required. So if you were a C Corp, have earnings and profits, you still have to file the M2, even if L and M1 are not required. If you are not required to file these schedules, then you must check the yes box on line 11 of Schedule B, and these schedules can still be completed even though they are not required. It is up to the taxpayer. Schedule M2 is only required if the corporation was previously a C Corp and has accumulated earnings and profits. So if you're not that, you do not have to complete Schedule M2. However, the IRS advises all S Corps to complete M2 because there may be future transactions, such as merging with an S Corp that does have ENP, where calculating your AAA may be necessary. So, not required, it is optional. IRS advises that you do go ahead and complete it. Schedules M1 and M3. Corporations must file Schedule M3 if they have total assets at the end of the year of $10 million or more. Corporations with $50 million or more of assets must file the M3 in its entirety. But similar to what we've seen before, if the corporation has between 10 million and 50 million of assets, then they can opt to complete only Part 1 of the Schedule M3 and to file the M1 instead of Parts 2 and 3 of the M3. If the corporation chooses to file M3, even though they're not required to, they can do that, but then they have to follow these rules. I am not going to show you Schedule M3. If you want to see it again, we showed it both with the partnership video and with the C Corp video, so you can check those out in order to refresh your memory. And that is going to do it for video 7. This is the last of our entity-specific videos. In our next 2 videos, which are our last 2 videos for part 2, we will discuss specialized tax returns for various types of entities and businesses. So I will see you in video 8.